Dziękuję. Thank you, everybody. It's a treat. It's a real treat and honor to be here. Thank you for the Bitspiration team for having me out. I am here because I do believe the next big innovations will come out of Poland and might very well be in this room itself. And I am an ardent fan of anybody who's pursuing the entrepreneurship path and very much want to support that. Today, we're going to give you guys a crash course in fundraising. This is sort of like fundraising 101 through 104 in 40 minutes. It's a crash course that we give within the accelerator. But before I do that, I want to start off with a little story, which is that I just had 4 nephews born in the last 7 months. And I'm Hindu, so in our family, we do this thing called a mundan, where you shave a newborn baby's head, and it signifies clarity and getting rid of past karma and all of this stuff. But it's also a time when you have these astrologers come to the family. And Indians can be incredibly rational, they can be incredibly scientific, but when it comes to astrologers, rationality goes out the door. So you can have a hyper-rational Indian who'll be talking to some Guruji who will say, you should wear the color green, and they'll believe it without questioning. And so the philosophy behind the astrology is that based on the time that these babies are born and the location of certain planets in the universe, you can predict what's going to happen to the child. So if Venus is in an auspicious place in the sky, your child will be beautiful. And effectively, any attribute you can affix to different planets in the skies. And different people can choose to believe it to the degrees that they want to. But I was talking to the astrologer who was there, and I said, okay, if everything's so predictable, then what's the planet that controls fundamental disruption? Because then this whole venture capital game can be really easy. You just have to look at somebody's chart and see if they have the planet and then just invest in them. And the astrologer paused and they said, actually, if you really want to know the honest truth, fundamental disruption is one of those attributes that's not attributed to a single planet. And in fact, it's based on timing. It's the alignment of 3 planets, or 3 bodies, that have to align for there to be huge disruption, and those 3 are the sun, the moon, and the earth, and it's both an alignment and an eclipse. One of the bodies eclipses the others, and the energies just create this huge disruption, which I actually thought was pretty insightful. But then I said, so if you don't have that, if you weren't born with those 3 bodies in alignment, and you're trying to go for fundamental disruption, what can you do? And the astrologer sort of whispered to me, and they said, you know what, at the end of the day, it's all free will. But if it makes you feel better, I can sell you this crystal, and you can hold it and get fundamental disruption. In many ways, I feel like that I wish I had a crystal that I could bring to you from Silicon Valley today to say, you know what, if you need fundraising, if you need funds, all you need is this crystal, and you can fundraise. But the reality is that you actually already have the power yourself. You actually don't even need the crystal. If you have a team of 5 A+ star players, and you get the timing right with the market, the world is yours to disrupt. And if it makes you feel better, I can sell you something, but the reality is that you guys have everything you need already. And it's already been proven with innovations like Skype that came out of Estonia, and others that are countless within Eastern Europe as well. The challenge is a psychological shift, in my mind, and knowing a few basic rules that to hack the game of fundraising. And really, there is a chasm that exists, I think if you're in Poland today for fundraising, that's not too different than the chasm that everybody talks about in Silicon Valley, the crossing the chasm, the Jeffrey Moore crossing the chasm, where here, there's early adopter funding. You can get $200K to maybe up to $1 million from different sources of capital that exist in Poland. But then you hit this chasm of how do you raise the money to build a big company. And that's a little bit about what we're going to be talking about today. So today, we're not talking about angel funding or raising a couple $100K. We're going to be talking about crossing that chasm and going after big institutional money. And I'm going to share with you what the great entrepreneurs know that the good entrepreneurs don't. And this is, in fact, what the great entrepreneurs in Silicon Valley know that the good entrepreneurs in Silicon Valley don't. So I feel bad that this is sort of the day after last night's party, because it's going to be a bit of a lecture We're going to go and we're just going to try to give you guys a lot of material and information. But the hope is that there'll be some good nuggets that you'll gain from the lecture. Before I go into more detail, I want to see who's in the audience. So how many people are entrepreneurs? Oh, fantastic. Okay, and how many people are investors? Okay, so we've got a healthy mix. Okay, so I've got both worlds that I'm going to be catering to. But really, this talk is going to be to the entrepreneurs, and really, this talk is going to be some things that I only tell my accelerator participants confidentially when it comes to the fundraising process. This is the first time I'm doing the talk publicly. Okay, so let me start off by telling you who I am. So I was born and raised in the United States, and I'm the son of immigrants. So I'm a classic Indian American. So my dad's an engineer who came to the United States as a PhD student, because that was the only way to get in the 70s from India. And my mom's a doctor, sort of a classic Indian American family. I didn't know what I wanted to do when I grew up, and I still, frankly, don't know what I want to do. But I always had this love of entrepreneurship and technology from an early age. But what my professional background immediately is that I spent 6 years at Draper Fisher Jurvetson. And I had a couple of fantastic investments, but the two that I wanted to point out were two investments that I made that I seeded in India. These are companies that were started in India, in Bombay, and one of them should be going public. I hope I can say that. It should be going public in the US market next year, and that's Pubmatic. So this is, again, a company that was not at the time, was not in a US Silicon Valley headquartered company that since has migrated and now is, and I funded that company at a very low single-digit pre, and they should be going public next year in the United States. Comely is also an Indian-based company that's doing phenomenally well. And I just want to keep bringing up anecdotes of stories of people. Part of it is just getting heard, because there are people that are like you, that have been in the situation that you're in, that have crossed insurmountable boundaries that I know you're facing as well. And it's really just a question of finding those people that you trust and understanding the lessons that they learned. So Draper Fisher Jurvetson is the venture capital fund that's funded some of the companies that Tim was mentioning. So a lot of Elon Musk's companies like Tesla and SpaceX were funded by DFJ, including Baidu and Skype was funded by DFJ while I was there at DFJ. Before DFJ, I worked at McKinsey, and then I worked at two startups that were Kleiner-backed startups. Today, what I do is first I teach at Stanford. And if you want access to any of the materials, any of the lectures that we teach at Stanford, we publicly put them up at etl.stanford.edu. On the left, you can go and click on the online videos and the podcasts. Huge wealth of resources for everybody. The second thing is that I run an accelerator called Alchemist that's backed by Draper Fisher Jurvetson, CoSells Ventures, US Venture Partners, Cisco, and SAP. And it is exclusively focused on enterprise startups. So if you monetize from an enterprise or an organization, you should check out the Alchemist Accelerator. And we are always on the lookout for great startups, and you can apply right now. We're taking the next batch of companies today. Also on the site is our lectures. So if you go to the top right, you can click on some of the lectures, and you can see the lectures from the accelerator. And finally, the accelerator runs a founder hookup site called Founders Hookup. If you're looking for a co-founder, you can check that site up there. Okay, so today we're going to talk about the art and science of fundraising. The art is going to explore motivations and incentives, the psychology of approaching VCs, and tips during the pitch. And the science is going to be more around the economics of venture capital, the mechanics of driving a successful fundraising process, and key terms in a term sheet that the great entrepreneurs pay attention to that the good entrepreneurs don't. I don't know how much we're going to get through in the time that we have, and we're going to intermix the art and the science as we go through it, okay? So I want to first begin by, everybody talks about product market fit, but before you even think about product market fit, the most important thing is think about what you're passionate about and what you're personally motivated by. We want personal motivation product market fit first. And I say that because you need to get clear before you start the fundraising process of what your realistic outcome is that you're shooting for in the process. Once you get in bed with the VC, you cannot divorce that venture capitalist. So, you can fire an employee if you follow Euro laws, which I don't know, but there's other better people that of course know that. You can even split with your co-founder, which I hope nobody does. But once you get in bed with the venture capitalist, legally, they are entitled to stay on in that company. And you do not have the ability to fire them without their consent. So you have to think very carefully before you start this thing, the process of fundraising, about what your motivations are and who you want to get in bed with, okay? I say that because you realistically think about what exit you're trying to get. And the first thing is that the fund size that you pitch should mirror the exit outcome you expect. So if you're expecting realistically that you're trying to get to just a $20 million exit, if I could get a $20 million exit, I would be happy. You should raise from a fund that is a $20 million or relatively small size fund versus going for a $1 billion exit. There's two reasons why this sort of builds up. The first is that funds need to return a third of their fund with each investment. Typically, when a fund is looking at you, they're not looking at you on whether or not you yourself are going to be profitable. They're thinking about, can I return a third of my fund on this investment? That's the hurdle that you have to pass. And secondly, your payouts are going to be aligned with your board member if the board member's fund size and your realistic exit expectations are the same. We're going to go into the details of this pretty deeply and pretty quickly. So on the first point, there's a heuristic that's just developed in the Valley where in venture capital, you're realistically looking at an investment to return at least a third of your fund. And the reason why is just because of the empirical results of most funds. And it started way back in the 70s. This is Kleiner's first fund. This is their portfolio. It was a $7.5 million fund. If you take out the top 2 investments, were responsible for 90% of their returns. That pattern between 2 and 4 companies out of a portfolio has remained largely consistent across a large bunch of funds since then. And so, generally speaking, there's this notion in a lot of VCs' minds that they have to return a third of their fund when they're looking at you as an investment. So if they have a $1 billion fund or a $600 million fund, they're going to be looking for a $200 to $300 million exit when they invest in you. And that's partly why the rough heuristic is that if they own a third of your company exit needs to be equivalent to their fund size for things to clear. Okay? And so I say that because the big name funds are not necessarily better. Okay? And we're going to go, I just want you to understand how VCs make money so you can be as equipped as they are when you're in a negotiation or when you're talking to VCs, if you get to that point. Okay? So VCs make money 2 ways. Right? They make money off of what's called a management fee, and they make money off of a carry. The management fee is a percentage of the overall fund size that they get irrespective of the returns of that fund. So if you have a $500 million fund, a typical management fee is 2%, which means that fund is collecting $10 million of revenue every year for 10 years, even if the fund returns nothing. Okay? So that's the salary, effectively, of the venture capitalist. And roughly, there's an individual VC for every $50 million of funds under management. So if you have a $500 million fund, it's typically 10 general partners, and each VC is really managing $50 million, which means that each VC is getting a guaranteed check of $1 million gross every year, regardless of the outcome of their business. But the reality is that they deploy the cash for that 10-year fund within 3 to 4 years of the fund. And so it creates this double, triple whammy effect, which is that if you come to a VC and a VC gives you $1 million, they not only give you $1 million check, but on their books they're reserving $2 million for your future financing needs, be them good or bad. If things are going great, you're going to need more money. If things are going bad, you're going to need more money. So they reserve $3 million, even though you've only taken $1 million, which means that after 3 years, the venture capitalist has committed all of the capital in their fund, even though they haven't given out all of the capital. And so they raise another fund. And on that fund, they're collecting management fees as well. So at any one time, for an active VC, there's 3 funds that they're collecting management fees on. There's one that's in the middle, one that's in the end, and one that's in the beginning. And I say that because you have to understand the discrepancies in the incentives if your incentives are not aligned with that venture capitalist. So let's say that you are actually looking realistically for a $20 million exit. That's realistically what would change your world and make you happy. And you are trying to get funded by a big $500 million fund, okay? Once you take money, as I said before, you can't divorce your VC, and that VC serves on your board. And the board is the instrument that makes decisions for the company. And the board, each member of the board has equal rights. It's an equivalent vote. But here's how the incentives get misaligned. For the VC general partner that's sitting on your board from a big fund, their salary is, this is in US dollars, multiply it by 0.3 for Polish. Is that right? Or rather, do the opposite, multiply it by 3. The salary for the VC is $3 million a year. Okay, this is, it's going to be between 1 and 5 depending upon the VC. A founder, and you can look at the latest numbers, is between $100,000 and $175,000, so $150,000. So there's a 20x gap between your guaranteed salaries that you're getting and your board members getting. If you exit for a $20 million exit, and let's assume that you have 25% of the business, you're getting a $5 million check. The VC is going to effectively get $160,000. That's how much that individual, after you go through the math, will come out with. So that's another 30x difference in terms of the payouts. So if you're going for a big fund and you're really going for a small exit, the incentives are misaligned for the decision making. If you go for a smaller fund, they become more aligned. So for a smaller fund, the average partner might be making $300,000, and their exit payout will be about $1 million. And so things become closer aligned with your $150,000 and $5 million payout. Things also become more aligned if you have a big exit, if you have a $1 billion exit or more with the bigger fund. So because you cannot divorce your VC, once you take that check and you go over the sugar high of saying, I got funded, the next day, the sobering reality comes to bear, and you need to make sure you understand what people's motivations are to make the relationship sustainable and happy. I don't say this because you should avoid big VCs. Big VCs are fantastic. I just say this to set up the conversation later on in the lecture on things that you can do to control for that situation. This is more data on how small can actually be better. This is Vinod Khosla's personal returns on his investments. And the takeaway here is that when he invests less than $1 million, he has almost a 200x return on his investments. When he invests more than $1 million, he has a 4.5x return, which is not too bad. But still, he's got a 4.5x return, so there's a 50x difference. The more important thing is that when he's actively involved, there's a significant difference than when he's not actively involved. It's just another testament to the fact that your success is not correlated to the check size you're getting from the VCs. It's oftentimes inversely correlated. Okay? And then these are the top 10 performing funds of all time. Okay? If you look at the top 10 performing funds of all time, none of them were larger than 250 million US dollars as fund sizes. All the top 10 best performing funds have been $250 million or less. Okay? I just mentioned this again, not because I think the big guys are bad. It's just because I want you to think very broadly. Okay? So all this is great once you have options, right? And the big thing you're probably saying is, well, I need to get term sheets. I just want to have money. So what I want to talk about next is understanding the psychology of a venture capitalist. And this is the Ravi Belani school of thought. Okay, I am not representing Silicon Valley venture capitalists. This is my own idiosyncratic view of the venture capital world from my experiences from my various experiences in life. Okay? Okay, so here we go. So, I think VCs are hunters psychologically. And if you think about what a venture capitalist has to do, they have to evaluate thousands of pitches a year, and they will only fund a small handful. Typically, they're going to fund only 1 to 3 companies a year. That's your dilemma if you're a venture capitalist. And so continually, what's going on in your mind as a venture capitalist when you see a company is, 1, are you any good? I mean, should I spend my time on you? Are you really any good? And then 2, if you are so good, why do I have a shot at the deal? So it's these 2 double-edged tensions that you have to be able to navigate as an entrepreneur to succeed. And the best entrepreneurs are able to handle that minefield of, 1, addressing the fact that, yes, I am good, and yes, you should pay attention to me, and 2, you have access to me in a way that other VCs don't. Okay? What's also going on in the venture capitalist's mind is based on those 2 questions. They're thinking of you as, this is a very broad generalization, as one of 2 types of investments. Is this a contrarian bet? So this is an example, could be Hotmail. Steve Jurvetson funded Severe Bhatia after 32 venture capitalists had said no. 32 VCs said no to Hotmail. Steve Jurvetson was the 33rd, and he said yes. He put in a couple $100,000 for a very large ownership percentage of the company, and he returned 500x his capital in 18 months. Okay? And that was a contrarian bet. Or the alternative is Google. Google is what you could be calling a rising star. Okay, so Google, their Series A was a 90 million pre, and Kleiner Perkins and Sequoia, which have only co-invested together 8 times, each put in $10 million at a $90 million pre-money valuation. And Vinod Khosla, I think it was Vinod, was famous for saying, never has so much been paid for so little, right? Because of how much they were paying for the relative ownership percentages. So the VC is also thinking in their mind, is this a contrarian bet or is this a rising star? The beautiful thing for you is that you have value either way. So if you think, I'm not the best company, that's actually an asset because you can be a contrarian bet for a VC if they can own a lot, okay? So VCs are constantly thinking about both of those things. So the metaphor that I like to use to our accelerator is that the best entrepreneurs are what I call a frolicking deer, okay? You have to do both things at the same time. And the whole dance of fundraising is about navigating polarities. There's different polarities that come up that are minefields. And if you know how to navigate those minefields, you'll have a greater shot of success. The first minefield is, again, those 2 questions of, are you any good? And if you are any good, why do I have access? And that means that when you're fundraising, you need to signal strength and access, which is the metaphor of the frolicking deer. You need to be frolicking away from the VC. You don't need the VC's money. You're moving forward and be in sight, but give the VC access to hunt you, okay? Because of that, the greatest asset that you have as an entrepreneur is the scarcity to invest in you. Does that make sense? The overriding asset that trumps even traction is the fact that the venture capitalist knows that you can only take 1 or 2 institutional investors. That is more powerful than even any fundamentals of the business when it comes to the fundraising process. Because your value is not determined by the average value. It's not determined by how cool the average venture capitalist thinks you are. Your value is determined by the marginal dollar. It's the 1 or 2 VCs that are going to tip forward and invest. Because of that, this is the Belani school of thought. Everything you do should be about restricting supply while signaling to signal strength when it comes to the fundraising process. So don't do pitches, do coffees. And this is the old adage, if you ask for advice, you get money. If you ask for money, you get advice. But again, if you just do a coffee with a venture capitalist and you're not fundraising, it signals strength, and the venture capitalist will always let you know if they're interested. You should be interviewing the venture capitalists. You should be asking them what they would do if they were you with the business, and what value you think they can add to the business. And you should be meeting a bunch of venture capitalists of all types. We'll go into this more later. But you should never just be pitching all the top-tier VCs or all strategics. You should have a mix of top-tier, second-tier strategics, angel investors, all at the same time, because your company might be the flavor of the month for one type but not the other. You also should separate in your mind the different attributes that a venture capitalist can provide, because generally people conflate these 3. They think about the venture capitalist as providing cash, providing advice, and governance. And the reality is that most venture capitalists are not good at all 3. In fact, I don't know if very, very few are. And if you decouple those 3, so if you think about, I'm going to use this venture capitalist for cash, but I'm going to round out my board for advice with these independent members, and I'm gonna secure control on the board with an independent board member that I like, you can come out with a better outcome than if you just restrict yourself to thinking about the universe of I need a venture capitalist and that's it. And the venture capitalist has to do all three of these things. So now let's get ready for the race. You understand the psychology. So how would you go about the fundraising process? The reason why you need to get ready, and what you need to understand, is that your worth is not a function of what a venture capitalist thinks of you. It can be a very hard fight to get a venture capitalist term sheet, but it's independent of actually what you're really worth. History is littered with phenomenal companies that got 0 or 1 term sheets. So all these companies got 0 or 1 term sheet up until their late rounds, and some even didn't get any term sheets up until their late rounds. EMC never got a single venture capitalist term sheet, even though they pitched a lot. Palantir ended up getting funded by the CIA because no venture capitalist was going to give them a term sheet. I don't want to mention the others. All right, so I didn't realize this was going to be recorded. Okay, so what I want you to do then is to drive the process like a Zen Master, which is I don't want you to get connected to, when you fundraise, you will have highs and you'll have lows. You'll be constantly pitching. Most of the times you're going to get no's, and you're going to have to be resilient and go back and pitch somebody else. And so this is a spreadsheet of how we do fundraising with the accelerator. We find that you typically need, our average is 55 meetings, 55 funds that you need to meet to get a Series A check, okay? And the way that we like to approach this is that we like to start out with a list of at least 60 sources of institutional capital. And then think about how many active meetings you can handle at one time. That's going to be a function of you reflecting on your energy levels, on what you can manage given what you want to do on the product side. I like to say 12, so that you're shooting to have 12 active meetings at any one time. Active means that you have a meeting happening that's coming up, or you have not heard from a venture capitalist within the last 3 days. If a venture capitalist has said no to you, or if you have not heard from them in 3 days or more, then they're inactive. And so you take your list of 60 and you want to prioritize 12. And of those 12, you should have no more than a quarter be of a certain type. So a quarter can be traditional venture capital funds, a quarter can be strategics, a quarter can be angels that are friends of yours, a quarter can be second-tier sources of capital. And when one falls off the list, you're a Zen Master. You just move the next one up, okay? And you reach out to that next one until you continue the process. If you get declined by the same set of investor 8 times, then you should reflect on the pitch. But hopefully after you go through it a few times, you'll find a certain class of investor where the story will resonate, where you'll realize, you know what, traditional funds really don't like us, but strategic investors really do. And then you'll amplify that to create competition. Our goal is to get you 3 term sheets. And when we find that if you have an active pipeline of 12, you can get to 3, and then you can start having the VCs compete. So we're going to go into a lot of stuff, but you know, the basic 101 of a pitch you should know. And there's a lot of resources out there on how to do a pitch. And I'm not going to go into that right now, but these are basics that you should look up online, and there's a whole bunch of fantastic resources on how to build a pitch. You should learn that. You should just know that. One of the basic ideas is that you can sort of fundraise off of either the potential of the idea or the traction, the results. And try to think about which category you fit into, because that'll dictate how you structure the pitch. But sometimes not having traction can be a big asset, because there's nothing to judge you against. If you have a phenomenal team and are going after a big market, it's sometimes better not to have any results. Because again, the biggest asset you have is the scarcity of supply. And you just need to have a VC be willing to jump forward because they're scared that another VC is going to take their spot if they wait, in which case you're raising off of the idea and the potential. Or you can raise off of the results. And we'll go into the balance between those two in a second. But these are some basics you should have in your pitch, and you should start with the basic pitch. Make sure you get these basic elements lined out, or find a basic pitch online, and make sure you get that just done as basic 101 preparation. But 102, and the art of fundraising, and this is going to be contrary to what I just said, is that the reality is that there is not one single best pitch, but that the great entrepreneurs change their pitch depending upon who's sitting across the table. And part of what you have to do is figure out the psychology of how that person makes an investment. I will tell you that when a venture capitalist makes an investment, they invest out of emotion and they justify with reason. Which basically means that when you're doing early stage venture capital, there's always 1,000 reasons why you can say no to a company. And so fundraising is not about the art of checking off all of the boxes. It's actually not about the art of having all of these things that I laid out in the basics of the pitch, although you need them. That's not why you're going to get funded. You're going to get funded because a venture capitalist has a shtick. They have their MO for how they make investments, which differentiates them from the other venture capitalists. And that's how they're able to navigate the problem that they have of they see 1,000 pitches a year, and they have to back one to three, and win those 1 to 3 when others won't. And that's because each venture capitalist, whether they articulate it or not, has an underlying way that they're going to make an investment. Some venture capitalists are driven by people. They're going to read a lot into who the people are on the team. Some are very driven by technology. They'll be looking at the technical underpinnings of the platform. Others are going to be motivated by strange things, and you might not really be able to guess what those things are. But there's a whole bunch of intangibles that are going to come into play. Some venture capitalists are pattern thinkers. Some venture capitalists are very detail-oriented. What you need to do is try to guess how that venture capitalist makes a decision within the couple seconds before you start your pitch. And you need to adapt to win that venture capitalist over and to seduce the VC effectively based on how they need to be seduced to try to get to a point where you can get 3 of them to invest in your venture. The way that I like to approach this is that most venture capitalists are not incented to tell you why they're passing or not investing in you. And the reason why is that the venture capitalist is often wrong. The best venture capitalists are wrong 2/3 of the time. You're lucky if you're right 1/3 of the time. And so they always want to have the option to invest in you for a later round, for your Series B or your Series C. And they always want to have the optionality in case they're wrong to come back in, which is why there's very little incentive for them to not like you. They will always want you to like them. Okay? So you really don't get any points just because a venture capitalist likes you. That's generally the norm. And so the problem is that the venture capitalist is not going to display their biases if they think that that's going to hurt you. And so the only time you really have to understand the venture capitalist's biases, in my opinion, is before you start talking. Once you start talking, the venture capitalist is making judgments in their mind. They're thinking, I like the way this person talks. Oh, this person's very concise. Oh, they're not concise enough. If you hit the B button on your PowerPoint, like I just did, it will blank out. When it blanks out, people will not look at the screen, they'll look at you. Okay? So when you're starting your pitch, that is a time when you can start to, read the venture capitalist and start to think, is this person motivated by energy? If I'm very energetic, will that affect this person? Is this person very analytical? And then ask the venture capitalist at the very beginning, say, I'm not sure if you've got a background on what we're doing, but here's the 10-second description of what we're doing. Just knowing that, I know your time is precious. Are there any key questions that you want to make sure that I address before our time is up? Most of the time, the venture capitalist will say, no, just go. But every now and then, a venture capitalist will say, yeah, actually, I've seen 5 companies in this space, and I don't believe that you're going to I don't believe there's differentiation. That tells you, okay, I've got to focus on differentiation. Or the venture capitalist might be a complete newbie and not know anything about that space, in which case you're going to have to really educate them and then cater the pitch accordingly. So once you've done that, I advise having a very minimal deck with a very thick appendix, which means that the main deck that you're going to do is going to be very quick. You're going to go through it really quickly, and then you're going to cater the pitch based on that venture capitalist by going to different parts of your appendix that you think that venture capitalist wants to hear, and then have them drive the discussion. Okay, some other psychological tricks. Don't ask a venture capitalist about their failures if there's any Q&A. If you ask them look up their past successes, ask them about their successes. They'll feel good, and they'll subconsciously connect you with them. And it has actually, it can have actually some pretty good impact. The biggest issues for your stage are typically the team and the market for an early stage company. So make sure you're really articulating the team and the market. We've had far more success in the accelerator with companies that have large, huge checks without traction. And it's been because of the team and the market versus the companies that have had fantastic traction, which I know is counterintuitive. But if you do have an excellent team and you're going after a big market, that is huge currency. Here are the questions that a VC might not articulate that they're really thinking. Okay, do I like you? Okay, do I want to spend 5 years with you as a person? Okay, and because a venture capitalist also doesn't really want to divorce you, and they're going to have to go to board meetings, and they only have 1 to 3 companies that they can invest in a year. So if they don't like you, that will also be an issue for them. Then they're going to have this other duality. You know, there's all these dualities going on in a venture capitalist's mind. The other duality is, are you passionate? But then are you also coachable? And both are important. So you need to be able to show passion. If you don't show passion, the venture capitalist will not like that. But then you also have to show that you're adaptable, which means balancing what we call advocacy, where you're making strong statements, and inquiry, where you're asking for input. The other bifocal duality that you're going to have to address is that the market that you're going after is big enough, and that your market entry is clear, specific, and actionable. That you have a bifocal lens, that you can both have a big market and a short-term focus. You'll be faulted for both. If you have a short-term plan, the venture capitalists will say, oh, but it's not big enough. And if you show a big market opportunity, the venture capitalists will say, it's a big enough market, but I don't know about the timing. I don't know if it's going to happen now. The best entrepreneurs navigate both. So when you fundraise, the valuation is just one term. And it's not the most important term, in my opinion. Everybody puts a lot of hype on the valuation. I raised at a 10 pre, or I raised at a 90 pre for Google. But know that the valuations, when you're fundraising early, are not based on anything intrinsic. All the valuation is, and this is the quick math lesson for how much you are valued at, is the amount of cash you can convince a venture capitalist that you need for 24 months divided by the ownership percentage that they require. Okay, so if you can convince a venture capitalist that you need $2 million and they want a third of your business, then your valuation is $6 million post. If you can convince the VC to take 20%, then your valuation just went up to $10 million. But the valuation doesn't mean anything. All it means is that numerator and that denominator. The amount of cash that you can convince the VC that you need divided by the ownership percentage that VC is willing to take. Okay? That's it. Now, when you're doing your initial fundraise, you're raising off of the idea, right? So it's off of the team and the market. There's no traction to prove anything out. And your valuation is just based on that formula that I said. When you do your next fundraise, 18 months later, a year and a half later, suddenly you're going to be expected to have results. And then your valuation will be more based on fundamentals, on whatever metrics are used to value your business. The science and the art here is that you have to think about what your goal should be as a CEO is to try to get the valuation to a 3x markup 18 months later. So if you raised $2 million and you gave up a third of your company, so it was a $6 million post, you want to have an $18 million pre a year and a half later. And that's going to be based off of fundamentals. So you have to think to yourself, what do I need in terms of metrics for my business for the company to be worth $18 million a year and a half from now? And then you have to think, how much capital do I need to build up to that point? And then the process is iterative. Then you might realize that, oh, I don't need $2 million. I need $3 million to get to an $18 million valuation. And then if you take $3 million at a third, your valuation suddenly went up to $9 million for your Series A, which puts the bogey at 27. Does that make sense? So there's sort of this iterative process by which you want to think about your capital raise with the goal, and this is just the textbook goal, that you should try to shoot for at least a 3x markup a year and a half later. And that's going to be based on fundamentals, and this will be based on purely just negotiations. Okay. So I was going to go through a lot of terms, but we only have 5 minutes left. And this is the really dry stuff, so I'm not going to do a lot of it. I'm going to just see if there's any key points that I want to hit in on. I think you understand how the valuation's done. I'm not going to show you how to calculate it, but basically all you need to know is how much cash you're taking in divided by the ownership percentages. This is an important one, which is the employee pool. So normally if I said I'm going to give you $2 million and I want 25% of your business, what's the post-money valuation for that? Right, so how do you calculate it? It's $2 million divided by 25%, so that's an $8 million post, which means that the pre-money is just 8 minus 2, or 6, okay? The employee pool, and I know laws are different between Europe and the United States, but in general, the employee pool, the venture capitalists, I might also say, but in addition to my 25%, I want to have an employee pool for you to give options to other employees of 20%. That employee pool comes out of your equity, not mine. So, but what happens if we run out of the employee pool after I fund you? What happens is that the board will get together and just issue new shares, issue a greater employee pool. And at that point in time, the equity comes out of both of our hides. Does that make sense? So let's say that you had, this is hugely significant. The takeaway here is that if you can reduce the employee pool down to as low as you can, it's good for you in a very, very non-trivial way, and you can always up the employee pool later. So if you own 40% of a business and you were raising $2 million for 25% dilution, that $2 million will dilute you down from 40% to 30%. You dilute by 25%, okay? If I, and I as the venture capitalist own 25%. You own 30%, I own 25%. When you factor in the employee pool, that's an additional 20% on that 40. So that's an additional 8% that comes out of you. So you go down from 40 to 30 to 22 with the employee pool. If the employee pool came afterwards, then we would both spread that pain in our ratios, which would be I would own 30%, you would own 25%, or the entrepreneur would own 30%, the venture capitalist would own 25%, so it would almost be 1-to-1. So you effectively gain ownership percentages for every percent that you reduce in the employee pool. I'm not going to go over this. We have 2 minutes left. So let me talk about co-sale rights. This is something that great entrepreneurs get that good entrepreneurs don't. Okay? A co-sale right is the right to, is that when you, this is the way to hedge against the scenario before where the venture capitalist wants to go after the $1 billion exit, and you're fine taking the $50 million exit or the $20 million exit. In that situation, there's normally a provision that's put into most US term sheets which says that you cannot sell your equity as a founder unless I, the VC, get to sell my equity in ratio alongside you. And what that effectively does is it really prevents you, it makes it very difficult for you to sell your equity, because if you want to sell your equity, no self-respecting investor is going to buy it if the investor is also selling alongside you. So what the great entrepreneurs do is that they put a provision in their term sheet asking for a carve-out of a percentage of their equity to be immune from the co-sale right. So that way, let's say you were going to sell, let's say you do a fundraise and it's a Series B, and it's a $50 million valuation. It's fantastic. You can sell part of your equity into that round without having to go through the process of requiring board approval, and take money off of the table to secure your future and further align your incentives with the venture capitalist. Okay, so I'm not going to go. The basic takeaways for you in Poland are focus on the team. There is nothing in this world which 5 brilliant founders can't conquer. And the entrepreneurs in Poland are as fantastic as the entrepreneurs in Silicon Valley. It's just about understanding, assembling a whole team, which is, the scarcity in India when I invested in Comely and Pubmatic was the product, was finding a phenomenal product manager. And if you can get that right, there is nothing, and if you can understand product market fit, there's nothing you can't do that we can do in Silicon Valley. It's a beautiful, beautiful world that you live in for all the reasons that Tim was mentioning before. Everything's being democratized. I would focus passionately on getting to product market fit, and by that by market I mean a global market, not Poland. And find somebody who really can understand to drive that. If you can't get to product market fit, then find acqui-hires here, and if you can, develop a path to go towards one of the financing centers and leverage your home base as a competitive advantage in that. Okay, I'm out of time. I hope that was helpful. Thank you, guys.
Thank you.
And I'll go to the... Okay, there we go.
Do you have any questions? No questions? Okay, thank you, Ravi, for your presentation.
There's a question.
Okay.
Do you accept teams in Alchemist? Do you accept teams from Europe?
Yes, we do. We had our first Estonian company. That's just in the most recent class. We do. So we do not evaluate companies based on if they're European or not. Everything is evaluated as on an equal stage. But we very much want to take more European companies.
Ravi, I'll ask a question about the famous idea of getting to $1 billion valuation. So do any self-respecting entrepreneurs actually put together a pitch deck that shows them getting that far, or how you know?
Getting to the $1 billion value. So yes, most entrepreneurs will want to showcase that there is $1 billion potential in the market. In fact, everybody will want to. All the venture capitalists will be thinking about that. If you're in a market that's big enough, that's known, you don't need to articulate how you're going to get to $1 billion. The reality is that you need to show how you can get to $100 million in revenue in 5 years. So that is the more important thing than the $1 billion valuation, is a $100 million, or if you're in some other market where there's a comparable metric, such as nonlinear customer acquisition growth, that a VC will read into, that will be fine as well. Yeah.
And yes.
Yeah. What do you guys do with the companies with the single founder, of the idea with the single founder?
What do I think about the single founder?
Yes.
I think you can build great companies with a single founder, or a single predominant founder. I've seen successes with 1 to 2 co-founders, but it's very, very, very difficult. So it's a very, very high bar that you have to pass, and you effectively have to be a triple threat. You have to be strong on the technology side, strong on the business side, and also be able to effectively build your team. You know, what we're looking for in teams are 3 things. We're looking for teams that have a sense of strategy, where they are going after markets that are big, that can operationally build out product, can actually build effective products, and then can hire and retain talent. If you're able to do all 3 of those things as an individual CEO, then we're not opposed to solo founders. I mean, there's examples such as Larry Ellison that have been very successful at that. But I would, unless you're of that, the far bigger concern with single founders is that they're not able to hire and retain talent. It's that they're a single founder not by choice, but by necessity, because others don't want to work with them. So that's the bigger concern. Yeah.